Our next guest says that there is risk the bear market could be roaring back. So let's go off the charts with Chris Verrone, a Strategas, a Baird company. Chris, what levels are you watching? What are the charts telling you right now?
Yeah, well, I think we got to put the last several days into some context here, and we've had this rally over the last couple months. Remember, the entire move took place below a downward sloping 200-day average. And I thought what was interesting on Friday and again today, for the first time in a couple months, you had all the major indices go on and make new one-month lows. And our rule really has been when you make a new one-month low underneath the 200-day, it's a pretty good message to step aside. It's often a sign that the downtrend is reasserting itself. So we got that on the S&P, we got that on the triple Qs over the last several days. And if you go to the second slide, what we show you here is the number of individual stocks making new one-month lows has started to re-expand here as well. On Friday, about 30%. Today, about 50% of the S&P made a new one-month low. So you have names in weak trends making new one-month lows. It's historically a signal that, hey, let's take a step back from this rally. Let's protect ourselves. Let's preserve some capital. Now, what I think is driving all of this is this move in rates. And our big call the last several months has been that bond yields would remain stickier than the consensus believed. I think we certainly have seen that with 10-year yields here back above 310, but really 2-year yields, I think, is the big story. New cycle high on 2-year yields. You have European yields on the verge of new highs as well. But what's really curious about this move, despite yields up, we've seen nothing from banks. So banks remain weak. Utilities have continued to exert themselves as leadership. So I see late cycle leadership. I see banks weak. I see utilities strong. And I see rates at new highs. Now, if you think about this just in terms of leadership, our other big view here has been sell stuff like technology, sell stuff like discretionary in favor of energy. So last two slides here look at tech relative to energy. I think this is one of the most important pairs in the market. This couldn't even get back above the 200-day. This has failed. And then lastly, discretionary versus energy, right? This is the whole secular leadership debate right now. I prefer the energy names over consumer. I think this has failed. I think rates up and risk to S&P here.
Hey, Chris, it's Tim. I prefer the the energy trade as well. And I guess my question ultimately back to some of the leadership that had been defining the bull market for 5 years. The underperformance of semiconductors, and I talk about semis all the time, to the S&P. So I look at that downtrend all the way back from, say, December of 2021 of semis to the S&P. Looked like we were breaking above that downtrend, but in fact, doesn't look like we ever did. Can you comment on that? Because that's a relationship that really has defined much of the market of the last 10 years.
Tim, great point, and we're all over that. We talk about it every day. The two leadership relationships that have really defined the decade were semis over S&P and discretionary over S&P. I think both are done. Just go chart by chart among the semis. NVIDIA, weak. AMD, weak. We've seen Micron break down. Qualcomm has rolled over. So I think you're spot on. This change away from semis is not a cyclical change. I think it's a secular one. I think semis are done as your leadership. They were so good for a decade. Don't expect it going forward.
Thank you very much, Chris Verrone of Strategas. Let's go ahead and trade this. Guy, I'm going to turn to you because Bonawyn sort of already had a say in his piece when he was talking about the 2-year, the 10-year, the relationship between the two, and then each of them on their own. But Chris brought up some interesting charts there. What do you make of them?
Well, I mean, he brings up the semis, and Tim said this for a while. I mean, that's the new oil, and if they start to roll over, I don't think it augurs particularly well. I'll say this about yields quickly. You're in an environment now, in my opinion, that if 10-year yields go higher, it's probably not good because they're not going higher because the economy is getting better. And if yields go lower, it's probably not good because it's probably some form of flight to quality because the market's selling off. But I'll tell you, if you're looking for a trade, that TLT traded down to 108-ish back in October of 2018. Dan can tell you exactly what happened back then. And we made that low again. So a little bit of double bottom to trade against, and maybe you will see a flight to quality in the form of bonds here.
Dan, it's interesting. You know, Chris also brought up financials and not having done much there, even as rates are moving higher. I'm just looking over 1 month, down about 0.9%, sort of smack in the middle of all the moves.
They don't act great. And I know Mike Mayo was just on the OT with Scott before, and he was talking about how well capitalized these banks are and just really how different they are than the last sort of recession that we had, you know, prior to the pandemic, that sort of thing. They don't act well. I mean, I just say keep an eye on JP Morgan, closed out around 114. 110 is that kind of line in the sand, and I think that would be a good indicator just about how bad the consumer is going to get. And we've been talking about the outperformance of Goldman and Morgan Sachs, Goldman and Morgan Stanley over the last few months or so, and some of those more investment bank looking ones, not the money centers, have acted a bit better. And I'll just say this, what Guy just outlined about yields is that, you know, that 10-year, if it were to come in, if there is a flight to quality, it really speaks to the lack of growth, and that really does speak to the fact that you have a 2-year yield, you know, at 3.4 or something like that, and it just speaks to an inflationary environment, which again, going back to the whole theme about this block, is that that should weigh on equity valuations.
Absolutely, it makes sense. It seems as if it did on Friday and then into today as well.